Good morning, everyone. Welcome back to the Schwab YouTube coaching channel. It's our Thursday edition of Trader Talk in today's market. I am your host, Kevin Horner. I'm a senior manager and trading coach here with the Charles Schwab Education team. I want to thank you all for joining us today. Of course, on a Thursday here, you can expect me to be going solo with all of you. I am going to be joined by Barb Armstrong in the chat this morning. There she is. Hey to Barb. Make sure you're saying hello to Barb as well. You can utilize the chat to submit comments and questions that Barb and I can keep an eye on. If I can bring them into the discussion today, happy to do so. If not, Barb will be there to pick up the slack for me. Barb and I are good friends, and she and I have been attending these in-person workshops together. She's a wonderful coach, and of course, her story is tremendous as well, having been a previous attendee to these shows and deciding that she wanted to participate. So instead of taking on the learning, she went through the whole process and is now a wonderful coach. So anyway, we got plenty to get to on this Thursday. So remember to follow Barb and me on X, as she just pointed out here, Kevin Horner CS, Barb Armstrong CS. And if you're not already doing so, please make sure you're subscribed to the YouTube channel we call Trader Talk. So with that, let's jump to our disclosures and then we'll get down to business with all of you. So first of all, keep in mind that our conversation here is exclusively informational and educational. We do not make recommendations. We do not make endorsements for any specific approach to trading the market here. We do, however, discuss technical analysis. We bring those concepts and strategies traders may choose to employ into our discussion as we review the areas of the market with you all. But it's important to think of technical analysis merely as one piece of your decision-making puzzle, not the entirety of it. So simply put, don't base decisions exclusively off what you get in the way of technical analysis. All right, here in this class, we are more analysis driven. And what that means is we take a top-down view of the broad market. We're going to look at the major indices, the S&P 500, the NASDAQ 100, the Russell 2000, definitely going to hit up the transportation index, probably get a peek at the semiconductors today as well. And then we expand out to sectors and commodities, for example, other areas of the market that are important for us to keep a close eye on as we evaluate the back and forth of the market and where the money is moving around, so that we can get some ideas of leadership and laggers, and that hopefully can kind of paint the picture of what the market is up to for y'all. Maybe not just today, but also for the interim period, the short-term window here heading into the weekend. So with that, let's pull up our S&P 500. We'll get started there. We've been talking about our consolidative action here. Yes, we are down a little bit, as you can see, red across the board here this morning in the major indices, but really having not made any changes to our trend. Brent yesterday pointed out when we were playing this, having our conversation together, that when we are in this sideways period, as you can see, basically just going between this 200 range, right? 6,800 set to 7,000 since late November here. You'll notice that our moving averages have become flat. And commonly when this occurs, the moving averages tend not to provide as much in the way of resistance or support. So when we start trending like this, we don't necessarily think, okay, we gotta, or excuse me, when we're going sideways like this, as opposed to trending, we don't necessarily believe that the moving average is as significant for us as a potential rejection, for example. But what some traders will do is they'll split the difference of their range. So in this case, we've had this 200-point range. We're gonna, again, just nice round figures, basically 6,800 to 7,000. We could snap another line in between this and put it to 6,900 so that we have an idea of where we could start to see potential, maybe some potential horizontal resistance, if you will. And this is not at all uncommon. It's just trying to get a good snapshot, a good picture of the way that price action will often work, especially in these windows where we're moving sideways. And certainly, like yesterday, if I drilled into just this last 6 weeks or so, or pardon me, 10 weeks or so, you could see that our high yesterday did get into those moving averages, but also into that 6,900, and then we've now pulled back. So question short term becomes, are we going to get outside of this range? But ultimately, for a lot of traders, at this point, there's not a necessity to do anything until we trade outward above the red line, downward below the green line. And we can talk all we want about narrative involvement here. Obviously, there's a bit of concern about geopolitical viewpoint. We're going to talk oil here momentarily, but ultimately, if we are traders of the trend, we are waiting for the next clear picture, and that's going to be trading above the red line or trading below the green line, essentially. And that's going to help us understand, at least, not necessarily, again, one of my favorite points about technical analysis is, again, it doesn't tell you what's going to happen next, but it helps us understand how much risk we should be comfortable taking on or setting our exit strategies. So a move under the green line tells us that we have a greater risk for moves lower, right? Move above the red line, we have a greater risk or opportunity for moves to continue to the upside. That's what we're trying to basically level set on, right? So we can be potentially more comfortable on a close above 7,000, less comfortable on a close under 67.75 or so, somewhere in that vicinity. So now the last note as it relates to the S&P 500, we've been talking about the RSI, how it has basically just been making lower lows all while to our price action. But the ultimate viewpoint here, it is a bearish divergence, essentially, with us having made recent highs in the last the last 6 weeks here, having gotten into that 7,000 ledge, tested it. The RSI for a lot of traders would tell you perhaps that we're not likely to break to the upside, but at the same time, we could just be looking at this downsloping RSI as a confirmation of what we've been going through for 10 weeks, which is this consolidative window. And so unfortunately, we don't know if it's merely consolidation or something more nefarious. Now, some traders have been talking about the amount of volume they've seen here. Unfortunately, we don't have a volume mechanism to use as it relates to the index here, but for some traders, what you want to look at is maybe how much volume are we seeing in this upper range. If we've had a ton of volume in that 200-point range, as an example, and we've not gone anywhere, commonly many traders will say that looks kind of like a distribution phase, where ultimately prices aren't moving, but we're seeing a ton of churn, a lot of volume back and forth. And commonly that can be viewed as big pocket investors, big dollar investors, essentially moving to the sidelines, but selling to those who are willing to buy. And the question becomes, who is willing to buy up here? Not commonly, doesn't mean it can't happen, but not commonly your institutional investors, more commonly your retail investors like us, generally speaking. Okay, so let's move off of the S&P 500. Oh, I know what I wanted to do. Before we do, I wanted to talk briefly about the equal weight. So we'll hit up the equal weight index here in the S&P briefly, and then we're going to move off into the NDX. So pretty distinct difference here, right, everyone? We can see that we've been working that 20-day moving average. So the entirety of our period here from November 25, where we basically had that 200-point range in the S&P, and we look at the equal weighted version, not the cap weighted version, and we've got in that exact same window a bullish trend working against the 20-day moving average. Clear tests of the 20-day, opportunity to participate, opportunity to join the trend. Each of these, at least each of these for the last 6-10 weeks here now, you've had those chances. So again, what is this letting us know? It's telling us that our leadership is very clear, something we already know, not technology driven, right? It is driven by the groups in the S&P that are the small ones, and they can actually carry the equal weighted version of the S&P index for obvious reasons, because everything is level, right, across the 501 companies, but they are so much smaller versus the tech, the discretionary communications, etc. So a very important look, but again, an illustration of your opportunity in the S&P. Is it right now technology? Probably not. At least has not been, excuse me. We'll see if tech is prepared, as we'll go into the sector action, prepared for an opportunity. Now, the off of the equal weight, someone had asked, let's see the weekly on that. We're going to pull that up next, and then we'll go to the NDX. So just a quick view of the S&P 500 weekly. That is not a correct, there we go. There's all my drawing. Okay, so there you have it, everybody. You know, our COVID move. So we're looking at a 10-year S&P 500. You've got the COVID bottom, our wonderful rally into 22, where the S&P gave back 30+%. That was this down channel. We got back into gear here early 23, and we took ourselves to the new highs. And ultimately, we're watching that below us here, the 65 level. That's the 40-week simple moving average there. It has been good support for a lot of the time. In fact, we, outside of our the Liberation Day conversation and the concerns around tariffs that we got, everyone, outside of that, we've basically been above it since back to fall of 22. So that's a very clear indication of potential long-range trends. So a lot of traders will be monitoring that. And what you'll notice here is that 6,600 and the 40-week approximation, everyone, that approximately lines up with the 200-day. Now, the 200-day is a little higher. It will be at least, currently a little lower than 66. Here is where 66 is. And then notice that our previous tests have been around 75 75 or so, 65.25, pardon me. Okay, so long range view, daily view. Let's move on to those NASDAQ and the tech side of things here. Still real choppy, everyone, but ultimately sideways again. We've got the 20 and 50 right on top of each other, not necessarily giving us trend validation in any way, but ultimately validating the consolidation. You all know that we've talked about the percentage move that the NASDAQ made from the lows we saw in April, leading to the belief or maybe the thought that, yes, we can be just simply in consolidation, even though it's been difficult for tech. But the truth is, we're just allowing the 200-day moving average, that line in blue, to catch up with support. So we are building a story, if you will, that the tech space is just digesting a big move to the upside. And that's ultimately what it was, right? Just as a reminder, if we looked at the entire move here to the peak, the first peak before we started to breathe, 58% from the April 7 low to the peak we saw in October, okay? And so, no, we are not seeing trending up like we had been through all of this window, but it could be said that we are simply digesting, right? So we shouldn't be surprised by that. Our concern is that we've now been, even though we've been going sideways, we've had an inability to get back into that mid-tier, that mid-range. So here, the range is what, 26,200 to 24. So we're looking at about 2,000 points or 2,200 points. And so we could put ourselves at the midpoint about 1,100 up. So that'd be what, 25.1? So let's just snap another line at that level. So I'm just going to duplicate a line, edit that line, and I'm going to put it in exactly where I want it, 25,100. And I'll do this because I'm pretty particular about where these lines reside, everybody. So everything I said about the S&P going sideways and then taking this as an example, both directions, so that you can just kind of validate the midpoint of your range that we've traded in can be helpful as well. But you'll notice, from the top of the range, come down, bounce into, about a halfway point, roll over at the 20-day downward sloping. So yeah, we've seen, this kind of looks like so. And then, yes, earlier in the week, it was last Friday when we broke down, you've had some green candles, but our rallies are still met with selling. So, this still feels like more neutral to potentially short-term bearish as it relates to the 200-day down below. But we'll see. Question about that? Yeah, Rita, let's do that. Let's put a Fibonacci on there for you. Let me clean these lines out, and then I'll put the Fibonacci moves. We'll see. I'll bet that I think we found out yesterday, I think that the horizontal support we've tested is right around 38% retracement. So if we do that to the peak, oh, I'm wrong, 23% retracement. Yeah, so look at that, right to it about 24,000, everybody, 23,950. So it could be said that some traders are going to kind of keeping an eye on that. I mean, that all lines up. Of course, unfortunately, even though it all lines up, that looks good for us technicians who love to draw lines on our charts and try and gain validation from all of this. But bear in mind, there's nothing to say that that price action has to maintain there. More importantly, the question is, what steps will you as a trader take should the NASDAQ move to the 200-day and then move below it, right? Do we get a close below the 200-day? Do we get 2 consecutive closes below it? Maybe 3 in a row? All of that is very important for us as traders. More important that you know how you're going to act if that occurs. Not thinking about that, denying it in advance, that's going to leave you at risk for making a hasty decision. That's what we don't want to do. So, good idea, Rita. Thank you for that. Potential for a double top? Yeah, Barbara, absolutely. That could be considered double top. If it is a double top, the technicians don't want to see a trade under the bottom white line because a double top is met with what we would call a neckline here, essentially, the support line of that double top. And we don't want to see trades through to the downside because then that would tell us that we've got the opportunity for the height of the range that we have seen. And again, a lot of these concepts are very similar regardless of the true pattern that you're defining, but the concept is the same. Range, break the range to the upside. You can add the height of the range as an estimation, an approximation of a target zone, and the same to the downside. And so unfortunately, if we took this line and we broke this down, yeah, we have good risk here. And whoa, how about that? Does it line up with horizontal support back in the prior resistance, now potential support? It sure does. So all of that lines up and all of that can make sense. The question thereafter is, all right, I've got a position. We've closed below the blue line. Now my risk for trading down to this ledge is greater than it was when I was trading above the 200-day moving average. Should I personally, individually be reducing my risk? Some of you traders will say, no, I'm good. I can manage the fall of about 9%. I'll be comfortable. I've got the right position size. And other traders will say, no, I've got no comfort for that. I need to sell X percentage so that I can be comfortable should it get down there, right? And that's ultimately on us individually. Again, I can't tell you the right confirmation steps, the right confirmation process, but I can recommend and suggest that each of us traders needs to define what confirmation is for us. What is it that's going to make it easy for me to make a decision in the moment and put myself in a proper position size, right? So all of that stands to reason. Have a plan, stick to it, or what we often say, right? Plan your trade, trade your plan. Very simple stuff. Okay, NASDAQ. Let's move on to the Russell 2000 small caps. Small caps holding up except for yesterday's candle. I'll tell you what, at one point yesterday, everybody, we were feeling really good about yesterday's candle. We had a filled in beautiful green candle into the downtrend line. So our candle here, well, now it looks like we got rejected at the downtrend line, which is notable but not terrible here per se. We prefer that we would have had the breakout, the whole of the 20-day moving average. We didn't get it. Unfortunately for now, what that likely means is we need to monitor the 50-day here in purple, right? Because we tested it back here in the beginning of the month, tested it back here in late December. This is all after getting back above it. Remember, we were below it only for that very brief window here. The Russell, the small caps have been doing quite well. Now, yesterday, part of the reason I believe you've seen this pushback on the ledge from the breakdown, or rather from the rally that we had started midday yesterday, kind of stems from the Fed minutes. We got some Fed minutes yesterday speaking to the expectation of rate cuts and the decision to do so. And the conversation amongst the Fed governors was maybe a little more hawkish than some had expected. There was some specific Fed Reserve officials who appeared wary of cutting interest rates, as it were, and when they got together last month. And so even a few of these, or pardon me, in my notes that says several of these governors suggesting that the central bank may even need to raise rates if inflation remains stubbornly high. So these kind of comments obviously can have an impact on an interest rate sensitive vehicle like the Russell 2000. Now yields are climbing a little today. Again, we've seen kind of what I would reference as a bit of a relief bounce in yields, as opposed to anything else. The big move is the rejection at the downtrend line, and the fact that we sold down from 4.3 almost down to 4.25, or right to 4.25. So I think that's the more significant development. The question becomes, are we going to see a significant pop back in yields? Just remember what happens if we start to see this. And what I mean is, what is it that leads to yields rising? Well, it's the selling of U.S. Treasuries, as opposed to yields dropping, the buying of U.S. Treasuries, right? So if we continue to see selling of U.S. Treasuries, concerns relative to the overall broad market, that would be one reason you'd see yields climbing here. But if I were talking about it from simply the chart pattern, the technical viewpoint here, the fact that we broke down under all three major moving averages after having been above them, all of them for about 2 weeks there, is more significant than anything else. Even this very brief to this point bounce that we've gotten right now out of the yield. So see if we get a bounce and we get back into the 50-day moving average, that becomes an area where you may start to look for, where some traders would start to look for maybe a potential for a rollover once more. I did look at the CME third-party website, the Fed tool, this morning to see if there's been a significant shift. There really has not been. Expectations remain at about 2 cuts for this year, not likely to begin until the summer. So March, for example, is still very high, 90% likelihood of no decision or no shift to policy, I should say. So traders are at least positioning that way. Just be aware, again, as a third-party website, it's by no means declarative in nature. It's simply letting us know how traders are currently positioned on expectation of rate cuts. Okay, next up, let's hit the semiconductors, off 1%. But again, really hard to look at everything we've gotten out of semis here and suggest anything other than general bullishness over the 50-day window. You'll notice if I apply just the 50 there, we've had brief respites beneath it, but those have been your chances to join the trend. Now we have met resistance here a couple of times up there at that 83.60 level, and we are struggling to get through it. The 50-day moving average can continue to offer support for you as it relates to the semiconductors. But, this has been a little bit more volatile, but it's a real surprise when you give consideration to how strong the semis have been, and yet technology just cannot get moving, right, collectively. And it's because, due to software, really. I'll show you a chart on software. In fact, why not? Let's do it right now. Let's just look at software specifically. You can see how aggressive the move here has been. Even the 50-day is too slow. Let's put up a 20-day moving average. There you go. So if you've been watching the software space, you're probably familiar with this, right? You've had a pretty rough go of things. These are some of your familiar companies, your Microsofts, your Oracle, Intuit, Salesforce, of course. So a lot of these charts have this kind of pattern to them. Not ideal. This is kind of looking bear flaggish. However, it could be said that you're looking at it at maybe a zone of potential support, and you are seeing the RSI come back a little bit. And so we've managed to hold a level down here, but ultimately, for many traders, you're not going to feel too much more comfortable until we can at least recover the 20-day moving average at some point and start to build a new stair step for us. So bear that in mind as it relates to software. It's just not helping technology at all. But of course, if we can get even a relief bounce out of software, then there may be some opportunity to kick technology broadly and the NASDAQ maybe back into gear. I did see a question here about semis. I'm sorry. Let's see. Was it a divergence? RSI divergence. Yeah, let's look at that real quick. All right, get my moving averages. Yeah, so we made that last high, right? And we got up there into overbought conditions here. All right, that's what that red indicator there over the 70 line. And then this last one, we got up there, and you can see that was a very big divergence. So what does just a reminder of what a divergence implies, or what traders infer rather from divergences like this. The idea might be, again, just simply not yet ready to break, not yet ready to break out. And so as a trader, you might just be expecting a more of a consolidation, perhaps a price pullback to the 50-day. Remember, when we talk about going sideways or testing support, that can happen just by the passage of time, or it can happen very quickly with candles like, 2-day moves like this one followed by this one, where you moved, from 82.30 quickly all the way down to 74.60. I mean, that was a very significant, 600-point swing in, granted, a big index, but 600-point swing from top to bottom in 2 days is kind of an indication of just how volatile the thing can be. So again, RSI divergence, yes. Bearish, yes. But that could just mean more time prior to breaking higher, or it could mean ultimately that we have to visit the 50-day. We don't know. Still too early. Okay, next up, transports. So we've been monitoring the transports for good reason. We often, in this particular segment, when we do the solo class, we like to bring in the Dow theory pattern. So I'm going to do that, but just quickly notice strength here. 20-day moving average moved off of it real well over the last 3 days. Today we've got that bearish harami fully engulfed within yesterday's move. We'll see how this plays out, but the bigger story, I think, for a lot of traders continues to be the look at Dow theory. So the broader viewpoint here, the two Dow industrial average, the Dow transport average, looking to confirm each other. Are they both going to new highs at the same time? Yes, they are. That wasn't the case for a lot of this. You'll notice that the Dow Industrials got going really well here back in September, and they've just been continuing. And it took the transports until this year to get themselves in gear. In fact, we didn't take this out until January. And when we took out the most recent highs in January, you started to then get your validation of Dow theory. And so ultimately, we like what we see from this if we're bullish. We are getting confirmation. Now, the question becomes, can we continue to get this type of bullish trend over the next, say, 6 to 12 months out of the transports, or do we get this group to be sold down? So for example, when we see the rotation of money amongst the various sectors, the spaces of the market, it's fine for that money to move from one space, tech for example, into other spaces that had been laggers for a while. We don't mind it when the money stays within the market. The challenge is when that money starts to leave the market, that becomes difficult. And so one of our concerns as it relates to the transports isn't a concern so much as something that we'll look for. And that would be the potential for the transport index, the average here on the right-hand side, I'll go ahead and expand it for you, is to put us back below the range that we've broken from. So as technicians, we've had a breakout, a brief consolidation or flag perhaps, followed by another breakout, and currently trying a brief consolidation. What we don't want to see is that we get back below the level of former resistance, now potential support. All right, so this is representative of an area, or more importantly, the trend that we want to see maintaining. And the transports can be that kind of heads up. It's been instructive on this market right here. So we need to see this continuing. A throwback below that 18,000 level or 17.7 here would be a heads up that things might not be what we were hoping for. But in the interim, everything here from the standpoint of Dow theory seems to be validated at this time. So we'll take that. We, for now, we'll take it with a grain of salt because we know that the market is anything but perfect, and we have plenty of risk factors of which to be aware. So let's go back here. Let's talk a little bit about our sectors. So we're going to jump to the Market Watch tool. Take a quick peek here today. Now, how about a year-to-date look at our sectors? We are led by the same ones, everyone. Energy, materials, staples, industrials. We're not likely surprised by those. Maybe a little more surprised to see real estate and utilities doing well, as we've seen the yields falling pretty dramatically, right? The 25, 30 basis point move in yields will have a positive impact on real estate and on utilities. Would like to see, maybe the discretionary aspect of real estate get back into gear a little bit here. Of course, that is a key within discretionary, not having a great year. Financials so far, tech, all three of those. I mean, these are your more volatile spaces, and all are pretty red for the year, right? So clearly, for now, the new trend is a bit more defensive, perhaps a little bit more value oriented than it had been. We're not certain that that's going to continue, as evidenced by those charts we were looking at in the NASDAQ and the semis, sideways, holding up, consolidating, not breaking out, also not breaking down, but preparing, we as traders preparing for the potential for that to change, just being ready for it. But in terms of looking for trade opportunity, looking for scenarios of stocks and uptrends that you want to play or participate with, a lot of traders have been doing so by going with your leadership groups, right? And fishing in a well-stocked pond is what a lot of traders would say. Going where the money is flowing and going where you're getting the returns. That would not be a terrible viewpoint here. Healthcare is kind of a little bit of both ways. Barbara, good question. It's often said that because healthcare incorporates not just your providers, for example, your pharmaceuticals, but it also incorporates biotech. And biotech is one of those more volatile spaces within healthcare. So depends on your viewpoint, I suppose. But sometimes I would say that if you're thinking broadly, staples, healthcare, energy, those really kind of define the so-called defensive view of the broader market. Let's take a look at what's moving around here for you all today. So we're going to talk briefly about energy. Energy broke higher, and it's likely tied to the move we saw in oil. So I'm going to bring up the futures symbol on oil because oil has been crushing to the upside today due to the geopolitical risks that we've been hearing about from the administration. I do want to mention as I do this, though, remember that futures options trading, this involves substantial risk. It's certainly not suitable for all investors. We do ask you to be familiar with the risk disclosure statement for futures and options. You are welcome to trade those here at Schwab, by the way, but you do need to be approved to do so. So prior to being ready to trade, make sure you take your steps. As you can see, futures in oil up about 1%. They were up a little higher today. So we're at about 65.60 a barrel. We traded as high as about another dollar up. So we've pulled back a little bit. But ultimately, this is looking like the establishment, perhaps, of a new ledge, right? Because we've just held this and tested this a couple of times. This could go to green. So you're seeing this development and the potential, along with the narrative and so forth, around the potential for a conflict there with Iran, for example. That leaves us with a bit more risk and the potential to see elevated pricing here. Tomorrow, when I'm on with our man James Boyd, you will see us talking about some of those individual spaces like miners and drillers and so forth. So we'll take a look at that with you all tomorrow. Okay. So energy moving well today, also getting move out of utilities. So this is kind of an interesting chart. You don't often get a space like this to give you just textbook, if you will, moves like this, broke the downtrend line, started trending very quickly, rallied immediately to make new highs or to test the highs. In fact, this level is less important than maybe this one. Look at that. It ran right to it, everybody. And now it's taking its breath. So the question here, I guess, is, hey, are we setting up a bounce opportunity in utilities, implying perhaps again lower yields, right? If yields are going down, the potential for utilities to continue to rally is strong. The REIT side of things has broken out, which is also kind of notable here. Again, why are we seeing these vehicles move like such? Because traders are a little bit more comfortable with risk when they take these on, when they see yields falling, right? Because it's all tied, and generally thinking, tied to the comfort of buying U.S. Treasuries, which are implicitly backed by the U.S. government. They call that risk-free rate of return, 4.1%. But if you are a trader who says, I'm more willing to take on a little more risk, well, I'll take capital risk by investing in underlying companies that are paying interest or dividends equal to what I can get from the risk-free rate of return, for example. But just bear that in mind, at least an understanding of why. But you also need to know that REITs in general, which is really what the S&P 500 real estate sector is. It's largely real estate investment trusts. These may pose additional risks due to real estate industry risk, interest rate risk, as well as liquidity risk, which is very different than what a lot of companies deal with. So just keep that in mind also. Now, I mentioned housing. Remember that housing is a component of discretionary. Discretionary has been in pullback, but also could be said that this is an area of support, but we're getting a little uncomfortable if you're looking for trend validation here, because we are, I'd say 1, 2, 3, 4, maybe 5 sessions in a row below the 200 now. Yes, we've got the RSI and oversold rallying off of it a bit today, but yeah, yesterday we tried to get above the 200, couldn't do it, closed below it. So you've got, if today holds below 1, 2, 3, 4, and 5 days in a row below the 200. Not ideal for discretionary. And then let's quickly take the look at the home builders. And this is an important space, I feel, for the overall view of the health of the economy. In order for us to feel like we've got a stronger short-term situation playing out, you probably need to see housing break free. Now, I know that is different, right, than what you see on the chart here versus maybe what you're dealing with in our local communities, right? Because a lot of the conversation around local communities, housing, and so forth is the lack of supply at affordable levels, which is common because you've got many longer held homes at incredible yields, rates, costs is really low, or individuals who don't even have mortgages trying to sell to people who need mortgages and are having to pay much higher yields, much higher costs. Very difficult. So we are kind of in a stuck situation, and yet home building as a space is showing improvement. This stands out to me. The overall break off of the lows, the recapturing of the 200-day. Notice my ovals there at the 200-day test of support. I think this is a notable development. We need to continue to watch because this can be a bit of a heads up. Hey, there could be some improvement here. This space is trading differently than maybe what is expected of it, amongst us in our own communities and so forth. So I wanted to look at that as well. Okay, let's see. Where are we getting some ugliness today? Oh, how about financials? Let's peek here. Because financials, I think a lot of traders would tell you we made a good bounce at a good important level, and then all of a sudden here we rallied right into the 200-day. And so they wanted to, at least for the last 3 days, tell you this is what matters most. Horizontal support. We broke our 200-day trend line and we fell below it, tested support, held, bounced. Now we've failed at the 200-day. More opportunity to see the green line once more than to maybe get above the blue, but we'll see how that plays out. This is an important level for financials as well. If we were looking for a secondary level, we might do that Liberation Day move with the Fibonacci's there. So there's your 38% retracement. And if we were to potentially fall through the 38%, where could bulls come in maybe and mount a stand? Well, look at these last highs, or pardon me, these last lows, excuse me, and they're close to the 50% retracement. So I think some traders would kind of look in there, and then other traders might make it a rectangle just to increase the size of support, which is common, right? We often need to give our support and resistance zones a little bit of wiggle room there. So making that a rectangle might imply, or at least give the trader a reminder that they need to give it a little bit of a wiggle. So, hopefully what we're looking at in financials is a hold of the green area as opposed to a fall through it, but we have to be prepared for things to change and shift. Ultimately, got to take out the downtrend line. Get above there. What a shock. Have to get above the 200-day anyway, right? So all that stands out. Okay, let's see. What else do we have to work with? We got only a couple of minutes left. So we've talked about Dow theory. I did want to bring in the quick review of rate using my friend Rachel's charts. So let's just highlight, for example, here the way things look in terms of overall trend. So our S&P 500 stocks, we've got about 64% of them above the 50-day. Almost 64% above the 200-day. So we do have some positivity as it relates to the S&P 500, but our NYSE stocks making new highs has certainly shown a bit of a pullback there. That should not be a surprise, just given the number of stocks in the NYSE that made that move. That was a pretty significant push very quickly. Again, that is I think, speaking to the rounding out of the recent rally here more than anything else. NYSE new lows just kind of hanging out. Pretty low there at only 22. Now let's take a quick peek at where we're getting relative strength, everyone. Pretty good indication here. We've already seen it in the form of the quotes page. Yeah, I can share that for you, everybody. Hang on a sec. So energy, materials, industrials, where are they not? Not coming from financials, not coming from tech. Utilities doing well, real estate doing well. So remember, these are in relation to the S&P 500. Let me share here the market breadth script for you all. Remember, scripts that we share here are not guaranteed for timing nor accuracy. So this is market breadth. There you go, everybody. And then I'll also share the other one there, the relative strength. This is, oops, I grabbed the wrong one, everybody. Excuse me here. This should be, let's see. Oh, no, I've got the wrong one for you, everybody. I wanted to give you, I thought I had it loaded. Let's try one more time. I think this might be it. There we go. Okay, I've got it. So I can share this one with you all. Again, highlighting the relative strength of these various sectors of the U.S. market versus that of the S&P 500. If we need to, just as a brief reminder, you can quickly add your labels in here with a text note, like so. So let me share this one with you all as well. All right. So we are just about at time, everyone. I always appreciate you joining, though, especially on a Thursday class when I'm hanging out solo with all of you. So here's our relative strength grid. There you go, everybody. All right, so if you're not already doing so, please follow Barb and me on X, Barb Armstrong CS, Kevin Horner CS. Try to post for you there throughout the week. I'm prone to posting a bunch of charts. Barb is great about posting some charts and some uplifting content. So if you're needing someone who's going to post better than what you get a lot on X, Barb is a fantastic follow there. And of course, if you like the discussion today, the thumbs up down below helps me out. We can get this back in review and into the archive for you all kind of quickly, but the thumbs up will help us with the algorithm and get this viewed by even more individuals. We always appreciate that as well. All right, I am off to San Diego next week. We'll be back with you all tomorrow, of course, in a few days next week. But if you're going to be in San Diego, make sure you stop by and say hi during the market drive. And as always, thanks for being here. Have a fantastic rest of your Thursday. I look forward to seeing you all again real soon.